I'd love to start off with my favorite guy, Carson, who from CHI Volatility. So I'm just going to play a video over here, and we'll take a look at it.
Carson is back with us from CHI Volatility Advisor, Senior Managing Partner. Ken, welcome back.
People love to look first of the month to the end of the month. And actually, the seasonality is much less tied to a calendar month, and it's much more tied to the expiration cycles.
Okay, yeah. I was going to say, you think in terms of options calendar.
It's so important to understand it's the primary driver of the seasonality across the board. There's other effects that are part of it as well, but that's critical to the actual forces that drive the seasonality. We are through expiration.
Yeah.
Right? And actually, for all practical purposes, 2 weeks ago, we put the kind of all clear sign. Once those Von and Charm flows start kicking in and you haven't had the volatility in that window, the downside that you needed, it's all systems go. And that's what we were very clear about that. And sure enough, this last 2 weeks has been an incredible run. But I think it's critical to keep in mind when the market is up 20% for the year, you've had, by some calculations, $50 trillion of buyback in that year, a releveraging effect. And some portion of that, about 10%, we can wave our hands at it, comes January 1st of next year. Listen, that's $5 trillion in a world where $100 billion to $150 billion is what the incremental change and moves in markets today. The incremental amount that's pushing this market up 2% today is probably about $150 to $200 billion. It's nothing. It's nothing. A 2% move in the market is like adding $1 trillion, right? So it's this is a leveraged, low cap venture capital deal, essentially. That's what the market is at baseline, and people don't really realize that. So that effect is so important. And then you have incredibly slow time in markets in terms of 60% volume-weighted time during the last 2 months of the year, from mid-November to mid-January, actually.
So the action's very important there.
That's important. And then last of all, you have the biggest expirations of the year in December, always December and January. That has a massive amount of skew in it, much more than it usually has, significant amount of vol. That creates massive, that's that wall of worry people talk about. That's the actual supply and demand that drives that flow. So you're cutting time down on a massive amount of skew and volatility in the market that needs to force these Von and Charm flows right as you have massive buyback January 1st in the market on the releveraging effect. The last 2 months of the year, you'd be insane to try and short this market in that window, in my opinion.
Is it such that if you want to put on like some kind of a hedge before the end of the year, that it's best to do it around that event that has catalytic potential in November, if you think the catalytic potential is that high?
Yeah, it looks high to your average person. If you don't know what you're doing, you're going to go sell that, you're going to buy things around it. But the number one thing to understand is that event is the thing that's going to drive the end of year up move in the markets, or volatility broadly, up or down. And if you're not exposed to that, you're in big trouble between now and then. So they have this ace in the hole, which is demand, and this is a demand push economy, and millennials in particular looking to get into homes. And if whenever they spur that demand, all of a sudden you get surprises to the upside in terms of every single number across the board. So I would expect the same to happen in this period. The wealth effect, if I'm right, this market goes higher here, will continue to also kick in and get in that flywheel where all of a sudden, this demand push economy, things are hot again.
Okay, so
that brings in the steepener, right?
Exactly. You know exactly where I'm going, which is that's the one part of your thesis from this year that you're looking for it to come back into, because you're looking for like 5% plus.
This is exactly what we called for, by the way, 3 months ago. Not the end of the year number, but the action here. We've been saying for 2-3 months the Fed's going to be more aggressive than people think. They're going to lower the front end of the curve. The part that hasn't happened yet, which we still believe is coming, look for it, this is your moment, is for, as that happens, inflation to start kicking back up. And if that happens, which is what I see coming down the pipe, the steepener is the perfect trade, right? Because the front end is being held down by the Fed who's stimulating, and now the back starts taking off. We have not seen that in 20 years. That's important. We're going into an election. Policy matters. And there's a couple really big things sitting out there in the election that very few people are talking about.
Real quick, hit me what you think is the big one.
Immigration is the biggest by far. The core reason labor inflation hasn't been worse than it is because of an open immigration policy here in the United States.
Fair enough.
It's incredibly unpopular. Right. That's what's holding down inflation. And the second you close those walls and you close out inflation, labor inflation will go through the roof if this economy reaccelerates.
All right, so that's him talking about on Schwab Network about the flows that are going to happen over the next several months. You guys could take a look at the full video that's on YouTube. But I find this to be absolutely fascinating because guys like Babe Ruth calling the shots months ahead of time. So just to summarize it quickly, in case it wasn't clear there for some people, is that he's talking about structural flows due to options. And so we had options expiry that happened like today, basically, where if there was going to be any drop within the market, any weakness within the market, you would have wanted to see it now for that to then be exacerbated to the downside. But since that doesn't happen, that those hedges are basically bought back, and you have the market that basically the dealers who have to buy back the stock that they shorted in order to hedge their positions, and you have these flows that the stock market moves up. So that's one of the reasons why the catalyst that we had with the 50 basis point cut from the Fed, plus no event that caused a drop in the market, then causes retail and institutional players to buy. It causes the dealers to cover their positions, and all of a sudden you have this, like we saw the other day, 100 points up on the S&P overnight, and all these stocks gapping up because all that downward pressure is now gone. And he's saying we ain't seen nothing yet. That we're going to see a massive rise in these assets between now and mid-January because there's the window of weakness. The next option expiry happens in December when everyone's on vacation. So the odds are, unless there's some event a world event that happens, the odds are that we'll move up, just like we did last year. I don't know if you remember, from October 2023 to January, it was just this massive run up in crypto and in assets. And he says this sort of thing can happen again this year. I find that incredibly exciting because it's true. The path that he has laid out so far has hit pretty dramatically, and the Fed cutting 50 basis points, not 25, 50 is super surprising, because the market wasn't positioned for 50, like it wasn't fully positioned for 50, which means that the central bank is even more dovish than what we anticipated. So we shouldn't expect any cuts coming in anytime soon, maybe for the next year.
I think just look.
Not cuts, raises. No raises coming.
Yeah, definitely no raises. Yeah, I don't see any rate hikes in the future. It's really a question of these next two meetings that are left for FOMC, whether those will just be two more cuts at 25 basis points each. And I'm fairly confident that'll be the case. The futures market tends to agree with me there. If that's the case, I could see some support for the bull case there on that. And you're right. I think what was interesting about the end of 23 was that most of that rally actually started to begin at the end of October, prior to what we were, sort of describing as the Santa Claus rally towards the end of the year. So we got an early Christmas present, right there in October, which ended up signaling the bottom for the rest of 2024. And that continued to be a fantastic rise in overall markets. So we've drawn down now, we've pulled back and retraced quite a bit in markets. Now the question is, do we continue from here and get some of that early Christmas present before the end of this year?
Now, the interesting thing about the 50 basis point cut is not just the structural flows and the types of trades you can do on that, but also what it says about the nature of the economy that we're in right now. And I just wanted to play you this clip from Danielle DiMartino booth, who was on Fox Business News talking about this. So let's play it, and we'll see it on the backside.
And already you can hear it. The hand ringing is loud and clear. Joining me now, QI Research CEO, Chief Strategist, Danielle DiMartino booth. Just, Danielle, your initial reaction when you heard that.
For the first time since Paul Volcker, I will tell you that Jerome Hayden Powell defied the markets. They've never gone with less than a 79.8% probability of a move, one way or the other, and they went today at 61%.
But here's the thing I kept telling people. At Jackson Hole, that whole week leading to Jackson Hole, every member that spoke said gradual, gradual, gradual.
Yep.
I feel like he deliberately did not use that he kept the door open for this move.
He absolutely did, and he orchestrated this purposely, but he defied the markets. Charles, this is a good thing.
Let's talk about historically now. Okay, our first rate cut, going back 14 recessions. By the way, our buddy Kobasi put this together. I think it's fantastic. The unemployment rate in the past year, typically going into an unemployment rate that with the recession, right, up 9%, without a recession down 10. So look at this. I mean, the unemployment rate is rising so much faster than normal before first rate cut.
Right.
Real GDP, this is actually pretty good. I'm going to change. I'm going to do this differently. I'm going to call that a red flag. I'm going to say this is okay. But look at this. The debt, U.S. debt up 123%, yep. Obviously a red flag.
Right.
Savings rate has plummeted 2.9%. Yep. Normally it's 8.8%. So again,
we going to zero? Are we going negative?
You had a lot of red flags here.
A lot. Absolutely. Charles, the U.S. economy is not prepared for what the polls are telling us is going to be gridlock in terms of emergency measures, blowing up the deficit spending to alleviate the recession. We are not in a good place going into this as we have been historically.
Let's talk about another thing. I'm going to pick up a little bit on this. So the economy, right? One thing we talked about is savings. Foreign net savings, that's in the blue. When you just talk about a U.S. savings.
Net national savings, yes.
Negative. It's negative. I mean, How can an economy, this is not a soft landing. We just continue to consume more than we make.
No, I think Wall Street wanted to believe the soft landing narrative so badly that, as you said, only 9 out of 114 were even willing to go to 50 basis points. But that what you just circled, that's reality.
Jay Powell saw this. Bowman didn't necessarily see it, but she was always sort of giving off hawkish vibes.
He was going to get a dissent either way.
You made up a great point in your note, and I wanted to share it with the audience.
That's good enough over there. So essentially, this is just one data point among many that's showing that even though the labor market is still fairly strong, what are we at,
Mhm.
4.2, 4.5% unemployment rate in the United States, which is not like too terrible.
Right. And I want to remind everyone that we pulled back 10 basis points on the unemployment rate in this last report. So we're down now to 4.2. But generally speaking, like that's full employment. We're not at a point yet in which I would be terribly concerned about the unemployment rate.
Well, I didn't want to. I didn't finish playing that video because it goes on for a little bit longer. But she does make the point that consumer spending, is still up. It hasn't slowed, and that hasn't been like a harbinger for recession. You can have consumer spending up into a recession, but the idea that savings is low. So we have high prices, savings is low, consumer spending is still up, and the labor market is not bad. And so you have this weird mix of, there's all these signs that are precursors to a full-on deep recession, and then all these other signs that are showing, no, we could probably have a soft landing and even um, uh, a large bounce in markets, even a rebound inside of the general economy. And it makes me like really wonder, like there's no way for me to know what side to land on, but I'm curious about, as far as recession watch is concerned, if there's anything that you'd be looking for like, hey, if this sort of thing happens, um I, I'm thinking recession is a severe recession, as demonstrated by higher employment rate and a drop in the stock market. If that, you're going to say that's in the cards, because currently the yield curve that uninverted, right? That seems to be not the scary boogeyman that it was before,
Mhm.
and the unemployment rate ticking up from the bottom hasn't really rang any alarm bells. So I'm wondering if you think it's like the recession is sneaking around the corner, and what you might be looking for.
Yeah, I mean, that's where it's kind of tough, right? Like the main thing that I tend to look for, and I think we talked about this last week, is that the market will give us the early warning signal. The market's drawdowns tend to be the warning sign, because I think there are so many different variables that can tell us about the any type of impending recession, that the market is likely to reflect that in price, right? It's all baked in typically. And so I would be looking for some kind of extreme pullback, some kind of greater than 20% pullback that starts to get to a point where this is looking pretty darn bearish. But increases in volatility. As I look back at every recession in history and look at what price action told us at that point, the leading indicator is always the market. So that's the first thing I'm going to look for. What's happening on NASDAQ? What's happening on S&P 500? The problem with recessionary data is that we don't know we're in a recession until the data is like finally published 3 or 4 months or 3 to 6 months later, because we don't get GDP data except once a quarter. We don't get unemployment data except once a month. And so this data that we're relying on that's supposed to tell us whether or not we're in a recession is really kind of non-existent until we're already in a recession. So the best thing we can use in terms of an indicator is really the data available through the market, which of course is our ultimate judge, or our scale or weighing machine, if you will, of everyone's sentiment about where we're going, which should hopefully include some of that intelligence that we hope for. The common conventions, the collective wisdom of the market that's telling us like, hey, we've looked at everything. Here's every variable you can consider, and it's all baked into the price. So I tend to lean on the market more than anything.
Okay, so I completely agree, which means let me know if you think this follows. So I think you're in the same camp with me that, let's say we do get a 15% drawdown in the stock market. We're not talking about 10 years of a down market, because they're going to come in, either options flows will come in and bring the market up because people will monetize their hedges. The central banks will come in and pump it up. We can expect that a V bottom, essentially, if we get any severe drop. I mean, that should be the expectation with everything that we've seen over the last 10 years. V bottom. Would you agree with that?
We've covered that several times on the show as well. We've talked about how fast recoveries have been lately, and how the Fed and the federal government have basically acted as an artificial stopgap to any type of major drawdown in markets, which, the libertarian in me says, well, I would appreciate a free market. I really would. But at the same time, if you're an investor in the later years of your life and you've got a portfolio you're relying on for retirement, you don't want something like that. But for us, I would love to catch price at a 50% pullback. I would love to be able to rebalance a lot of my portfolio into a better price on Nvidia, a better price in the SPY or XLK. So I guess it sort of depends, like where are your incentives for something like this. But yes, we have spoken many times in the past that that in general recoveries seem to be swift.
The thing is, people like you and I can get the market down 40-50% if we get these large volatility spikes because we're prepared and we're watching it, and we would buy that, whereas the regular Joe Blow is not doing that. And so what I wonder what follows is that if that's going to happen, then the wealth effect doesn't actually. In fact, the wealth effect gets exacerbated because as the V bottom happens, then the assets go higher still, and now your portfolio is worth more of the assets that you're just holding. And so I'm wondering here, the Daniel was talking about here the savings for Americans on average is negative, but if we can still keep borrowing against or still keep benefiting from the wealth effect from the rise in the markets, are recessions now really just pullbacks in value of collateral and not like we don't care about the contraction of productivity within the markets because we seem to no longer really care about that. Tell me if I'm wrong here.
I think you're right. I think there's one variable that is a part of the numerator that maybe we're ignoring in general, and that is wage growth in the United States. That wage growth, I think, is contributing to continued persistence in consumer demand that makes it unusual in terms of our interpretation of what we expect to start happening pre-recession, right? We typically expect consumer demand to slow as unemployment starts to rise. There were a lot of surprising figures that showed up during COVID as well, where like there was this persistent rise in unemployment, but then consumer spending didn't really wane as much as people anticipated. And a big part of that was that there were many two-family homes in which the cost of childcare was so high that it was actually cheaper for one person to leave their job and have the other person retain their job while going on unemployment during that period of time. So it created this sort of artificial effect where the household is still creating income, still spending at the normal pace, in fact, spending more on online services and for, delivery services that created this transition in markets where we were kind of moving consumer demand from one sector to another sector. I think we're about to see something like that here too, where wage growth, I think, will contribute to an increase in consumer demand that we didn't anticipate, which could, sort of slow some of the impacts of what we think a recession might be here in the coming months.
So I love that you said that because that is exactly how I feel too. So let's get this. I think, and I think Kim is right. He's been talking about this, and some other people do, that we're not going to get any more rate cuts. We won't get any hikes, but we're not going to get any more rate cuts because we're going to get a reacceleration of inflation over the next couple of data prints between now and let's say February.
It's possible.
Yeah, because they started cutting before we actually got back to 2%. Right, because they were saying that they're trying to engineer a soft landing, and they sort of want to jump the gun here. Right, they put two cuts in at once. They're using the expectations-based policy of the Fed in order to get people to buy into the markets, and so they don't want a soft landing. But they're supposed to do not only focus on employment, but also price stability. Right, and we don't have the price stability at the moment. We're still have rising prices. Prices are not going to come down, and so they're sacrificing that inflation in order to get the growth. And so it seems absolutely clear that if they're going to engineer any soft landing at all, and we're not going to get that recession, which is usually that cleansing effect that causes people to drastically change their spending habits, drastically start saving, whatever, that causes the buildup of the savings that is the impetus for getting out of recession into the expansionary phase. If we're not going to do that, and we're going to just skirt that and get an expansionary phase, then we should expect inflation to come back, and we should expect inflation to come back hard. But while the Fed is holding the front end of the curve down, the 2-year rates, the short-term rates down, so we can get, let's say, 2.5% interest rates on the 2-year and 15% on the 10-year. Because if the inflation does come back, future expectation of inflation is that it'll continue higher, and we would be reaccelerating inflation from a higher level than we started at the beginning of this whole inflationary thing, which means inflation would go crazy. What does that turn it into? Wage inflation, right? Wage inflation, which then people have to compete more, and more money goes into the market. Plus this extra thing.
But wait, there's more.
Yeah, the border issue in the United States, right? It's the big issue of the campaign. So much so that Republicans, who were usually pro-open border, as far as free trade and that sort of thing is concerned, pro-open border, they've moved now towards closed border because of Donald Trump. And Kamala Harris has switched from let everybody in to no, we have to have secure borders, back into the whole like Clinton era sort of democratic idea. So both sides now are about this closed border. Well, if they actually go through with that and they do the deportations or even just close it, that's also going to add to wage inflation, because we're not going to have that cheap labor that's coming in from abroad. So that's higher wages from the inflation, and then higher wages again from the closed border and the protectionism, or whatever it is you want to call it, whatever actually happens after the election, which means we should see inflation, rocket over the next year and a half, 2 years. Just an insane level of inflation while they keep the rates down. I don't know what kind of market we deal with that is. The only thing I know about that is from the 70s, where stock markets or assets that are not inflation sensitive are no longer your friend. But to me, it's like the most exciting thing. Depressing for a lot of people, I get that, but if it's going to happen anyway, I might as well be excited by how interesting it is. And we haven't seen it in our lifetimes. I don't know how you're preparing for anything like that.
Well, I was going to ask you that question. What is your inflation hedge then?
Crypto is my inflation hedge. Short bonds.
We've figured that out, though, that crypto is not an appropriate inflation hedge. It hasn't provided the protection against inflation we hoped for.
So we're at 60,000 in Bitcoin when we have high inflation, right? Like wouldn't have expected.
We've had declining inflation for months now. Like that, we're almost on target. In fact, I think we've reached the Fed's target rate, right?
Yeah, we're at I think 2.5.
2.5, right?
Yeah, but there's these phases that happen within a change, right? So we had talked about in the last show that inflation is not strictly the number itself is not the problem. It's the volatility of it. Is it going to stick around? How much higher is it going to go? The uncertainty of it.
Sure.
We don't really have that same uncertainty now, because we had this ebb within the inflation. But let's say it starts rocking and back up. We're going to get that volatility again. And if that happens, money is going to start chasing performance. Okay, what are you going to put into? You're going to put in gold? Sure, gold has been up, but it hasn't been up like, we're not at 5,000 like people were talking about gold a couple of years ago. You're going to short bonds? How many people are there going to be shorting long-dated bonds? Like that's not a trade that people are normally doing. You're going to go long the short term? Maybe not, because who knows if the political pressure is going to cause the Fed to have to raise the rates drastically. So you're not going to want to be there. Okay. You're going to go into tips. You're going to go into break-evens. These are not instruments people are expecting like gangbuster numbers on.
Well, there's also some major limitations with tips and some of the insurance protected products. There's limitations in terms of how much you can even invest in those. So I think for the last time I checked the product, there was a $10,000 limit. So if you've got a fairly decent sized portfolio, that's I
didn't even know that.
That's not helpful.
You won't be able to go into real estate because we'll have the same problem we have now, where they can't sell the house. You're just sitting on it, and plus you're not going to refinance if you have a lower interest rate. So where are you going to go to? You're going to go to something that's going to show performance, right? So you're going to have to go to some areas in tech and some areas in in crypto, to me it seems obvious. And actually, there's one area that you actually brought up in the last show, which is energy, that I sort of like poo-pooed, and because I was like, oh, energy, they're gonna, new technology going to come and blah blah blah. But with the new AI bump, in fact, let's jump into this right now.
Yeah,
to
we'll
segue
jump
the
into
next
the
story.
Microsoft story for sure.